From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, inflation relief. Core PCE for January coming in at the smallest annual increase in 4 years. As the Treasury rally presses on, government bonds are in line for their best monthly gains since July. And as investors turn their focus to next week's jobs report and comments from Fed Chair Powell. We're going to begin, though, with the big issue. Inflation concerns take a backseat.
If there's less concern about inflation staying elevated, then concerns can shift to some of these growth concerns.
The markets are more concerned with downside implications for growth than they were about upside inflation surprises.
What we ask is, are lower yields actually more reflective of maybe something sinister with the economy moving forward?
I think most of it right now is the growth slowdown, where bond yields are sort of going down for the wrong reason.
There's this sort of whiff, if you will, of stagflation sort of maybe creeping its way into the narrative.
On a number of different fronts, you can both have, at the same time, higher inflation and weaker growth, which is a definition of stagflation.
I think the Fed will need to do more than what's priced because the economy is weaker than they think.
We do think that the inflationary trends will start to come down that will allow them to cut rates later this year.
Now let's dig a little deeper into those PCE numbers, because you have that line over here in white, and you can see that it has been behaving very healthily under that 3% level. And you're seeing that CPI in blue, as well as the PPI in yellow, also start to abate. PPI, those producer prices, of course, start to tell you what the consumer might feel as well. However, if you look at some of the reasons that the PCE has been moving lower, you have a little bit more reason to worry. I'll tell you exactly why as we flip up the board here and take a look at that spending data that we've been seeing underpinning the PCE. It's been falling 0.2% in January, and that is the biggest monthly decline in 4 years. And it doesn't feel like a lot, but you see how much it's actually turned negative. Over the past 5 years, that's only been on 7 occasions, 3 of those occasions being during the COVID pandemic. And we haven't seen a reading like this really since 2021. Speaking of data, I caught up with Ares CEO Mike Arrighetti just yesterday, who weighed in on his approach for navigating a volatile path ahead.
Our base case coming into the year was that you'd continue to see, solid fundamental growth. You'd see persistently high prices and inflation. Labor markets are still very tight. So, it's interesting when you think about public markets versus private markets. The public markets can get a little schizophrenic day to day, week to week. And I think in the private markets, we try to keep a longer term view. And at least based on what we're seeing, we haven't changed. I'm still in the camp of stable to higher for longer than changing our view that we're going to see increase in cuts throughout the end of the year.
Joining us now, Michael Goosay, CIO and Global Head of Fixed Income at Principal Asset Management, and Nisha Patel, Portfolio Manager of Fixed Income at Parametric. I want to pull up for both of you what the 10-year has looked like over the past year, because since we saw that high of 479 back in January, we have seen more than 50 basis points, more than a half a percentage point erased since the high just earlier this year. If you think about where the 10-year yield is headed, Nisha, where do you think that it is going to land, higher or lower at the end of this year?
I think we have room to end lower, given where we are today. Now, look, the recent correction and roughly a 50 basis point drop, I think a lot of that was some of the optimism being taken out of the market, right, that we quickly saw with the new administration, and initially what was a optimistic view and sentiment on policies and the impact on growth. You're now really seeing that being flipped on its head. Today's inflation print provides a big relief, because as we know, inflation is one of the 2 mandates that the Fed is really going to be focused on. So if we see any weakness on the labor market side with next week's payroll number, and you have an overhanging uncertainty, and we have the tariff deadlines and kind of that 1 month delay coming up next week, whether or not that happens. But that overhanging uncertainty, I think in my view, creates a pullback in spending, which could, as a result, slow down growth into the second half of this year, which again could warrant, that 10-year to slip, close to a 4 or sub 4%.
Do you think we get there, Michael? Do you think we get under 4% to end the year, or do you still think the risk is higher given an opposite set of forces that we saw really underpinning the bond market a little earlier this year?
Yeah, I hate to agree and make this an easy conversation, but we do think that the overall environment is one of slowing growth, moderating inflation, and that the Fed could be more active than what's priced into the market. And there is a high degree of relationship or correlation with the 10-year bond yield and that of Fed funds rates. So our view is that rates will continue to move lower. It's hard to put an actual number on it, but that certainly below 4% isn't outside of the realm of possibilities for 2025.
As these growth fears start to enter the market, Nisha, when you think about the jobs report next week, you already mentioned it. How concerned are you about those numbers? It's interesting. Even the jobless claims this week showed a little more fear, and that does not even bake in the Washington job cuts you're seeing on the heels of DOGE.
Exactly. So I think there's going to be a big focus on the payrolls number. I think a tiny slip up even really continues more of this rally and risk off sentiment. We don't have to be too far off of kind of the estimates here, but any sign of weakness in this payroll number next week is going to give, I think, more momentum for the bond market to rally, and for this, let's say a concerned or growth scare outlook to really carry legs here. So I agree with you. I think the jobless claims number, some of the consumer figures that we've been spending, that is really kind of overhanging on this negative sentiment. So I think any slip up next week, which we could see a possibility of, and then to your point, I think it's really going to be the forward-looking payrolls number, jobless claims number, that as a result of DOGE, as a result of layoffs, we may not necessarily see it in this recent payrolls number, but it's really going to be the focus of the next 1-2 months labor market figures and data that we see coming out.
Michael, I'm a bit interested in what you said about more movement by the Fed than what is priced in, because you've seen those expectations not only change drastically, you already have a market now pricing in more than 2 rate cuts this year. You think you get more?
It's certainly possible. As Nisha said, that the Fed's got a dual mandate. We need to make sure that prices are stable and moving towards the 2% target, and that the employment picture remains robust. And both of those seem to be moving in the direction that would suggest that the Fed can move back towards more normal or moderating monetary policy, and that is still lower from where we are today. So the short answer is yes, we think the Fed could go 3 or 4 times this year if the data continues to suggest that inflation is moving towards that 2% target, and that if the employment picture deteriorates at all, that'll become the real driver of how the Fed operates on a go-forward basis. Now, that doesn't mean that the economy is on the heels of some sort of major slowdown, but certainly something that's more moderating towards trend or below trend like growth would allow the Fed to move to a neutral policy rate.
I also want to read through where the real yield has headed. Nisha, you think about the 10-year headed for a 19-week low. What is that telling you?
Yeah, I mean, I think a lot of that risk premium that we initially saw being built in, around, again, the implications of policy, the possible inflationary impact. One component, interestingly, I think, again, early on this year, we saw a lot of focus on debts, deficits, obviously additional debt, the impact that would have, an extra kind of term premium being built in. You're not necessarily seeing that as much anymore. Again, the growth story here is really taking the narrative and is becoming a big focus, because, again, you're seeing a lot of kind of, this thinking around, look, if tariffs are going to take place in any form, and even just overall policy implementation uncertainty, this is already causing some pullback on the consumer side, which is not going to be a good thing. So I think in terms of just real yields, we still find them attractive given where they are today. But I think you've seen a little bit of that more inflationary and risk premium kind of being taken out of the market relative to where we started the year.
But interestingly enough, if there's a market that's somewhat concerned here, or very concerned heading into that March 4th deadline around the tariff strategy, Michael, what do you expect in terms of the overall impact here? Is inflation taking a backseat to growth because people are so worried about the consumer story here in the United States?
So inflation is going to begin to take more of a back seat. Some of the just more traditional year-over-year metrics would suggest we're moving down below 2.5% on core PCE, something that's more sustainable or more comfortable for the Fed. Tariffs do throw a wild card in here. We don't know. Nobody really has an idea of the administration's long-term plan, how this is going to be enacted, by how much, who's going to be impacted. So, we're looking at it as this is something to look through, to not lose sight of what our jobs are, which is to focus on long-term growth and inflation, how that should affect monetary policy, how should that affect fiscal policy, and ultimately, investing our clients' assets to take advantage of those opportunities. So, to some degree, it's hard to predict the unpredictable, which is what we're really being tasked with when dealing with this tariff environment.
We thank you both for your time this Friday. That is Michael Goosay of Principal Asset Management and Nisha Patel of Parametric. Very complicated market and, of course, a week away from Jobs Day. And up next, the auction block. Citigroup among the high-grade U.S. sales this week, pushing this month to the second busiest February ever. This is Real Yields on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we wrap up the month in credit issuance. And we're going to start with U.S. high grade. HSBC, Chevron, Citigroup, and State Street helping to drive the week's volume past $50 billion for the second straight week. On a monthly basis, the total for IG is more than $160 billion. And that makes it, as we've been talking about, the second busiest February ever. The record level was set just last year, and expectations for March are for $185 billion in sales. And looking at U.S. Treasury sales this week, we had offerings for the 2, 5, and 7-year. For the 2-year, it saw strong demand, with indirect bidders being awarded the most on record. And the 5-year sale also saw similar demand, and the primary dealer's award was near a record low. Speaking of corporates, I spoke earlier this week with Ares co-president Kip DeVere. We got his outlook on deal making.
Markets haven't really corrected all that much in response to a pretty significant uptick in rates, right? So markets feel expensive, but there's good confidence in the economy, generally in the consumer and in companies. So I think everybody wishes we could be a little bit busier. And again, we're seeing signs it's picking up, but it's picking up slowly.
Joining us now, Amanda Lynam, head of macro credit research at BlackRock, and Matt Brill, head of North America investment grade credit at Invesco. And we have questions across the credit spectrum, because if you're worried about growth and the market is screaming growth scare at the moment, then what happens to all that high yields? You think about the complacency you've seen in spreads. Has something got a crack there? Amanda.
Good morning, or good afternoon. Thank you for having me. I think one of the probably notable things about this mini sell-off or this mini widening is that actually a growth-sensitive asset class like credit isn't signaling that much concern about the growth backdrop at the moment. That's especially true in Europe, which I think that resilience has been really notable. And it feels to us that there's a bit of degrossing that's happening. That's probably a bit of a healthy spread widening, just given some of the uncertainty. But it feels that the bar for sustained widening in credit is actually quite high. And as you know, we had been constructive on credit spreads for really the past few quarters. We had advocated for tightening even when it was a bit out of consensus. We've finally, in early February, flagged the potential for some modest widening in credit because of that uncertainty. And even that hasn't materialized as quickly as we thought. So I think it's a reflection of solid fundamentals, really strong technicals. We do think some widening is possible. Again, I think that would be healthy, and it's a bit of a degrossing from our perspective.
Matt, what does that look like in the investment grade world as well? Do you expect a bit of widening? I know sitting there at the end of last year, you and your colleagues had some very specific expectations on where things were headed.
Yeah, good afternoon, and thanks for having me on. To start the year, I think we were very favorable on the corporate environment. I think there was a lot of concerns that rates might actually go higher, but that would really generally be good for credit spreads because all-in yield buyers just been so relentless. But you're starting to see a little bit of a growth scare here. IG spreads are about 7 basis points wider on the week. High yield spreads are maybe 15 to 20 wider. So we're seeing some negatives out there, but I would flip that around a little bit and say that you're up considerably on dollar price in both IG as well as high yield credit. So in a particular sell-off or a real growth scare, you would actually see high yield dollar prices down. They're up, they're just not keeping pace with the relentless rally that you've seen of treasuries over the last week.
Well, to that end, too, and I should clarify, you're right, you're not seeing that growth scare everywhere. It's really the Treasury market where the 10-year has fallen by more than 50 basis points since the January high. And because of it, we've written recently, this is amazing, that U.S. corporates are actually becoming the haven play as Treasuries get whiplashed. You had DoubleLine coming out with a thought piece on whether Microsoft was better to buy into than a U.S. Treasury. What do you think, Amanda? Is the U.S. corporate bond market a relative sea of calm relative to the U.S. government's own financing?
I think it's a great point. I think the positive fundamentals, the balance sheet improvement that these corporates have engaged in since the pandemic, coupled with really favorable technicals, often are underestimated by investors in our view. And so we actually do like corporate credit risk. We actually like even moving down in credit risk within the high yield spectrum, because there, notably, the fundamentals of high yield have actually been converging up to meet their investment grade peers in certain subsets. And so there aren't a lot of bonds to go around. The fundamentals are really strong. The technicals have been favorable and supportive. And so we do like taking credit risk. I think if 2024 taught us anything, it was an opportunity cost to being too defensive. So we do like that. We also like incorporating exposures that will position portfolios for a wide range of growth and inflation scenarios. So floating rate assets, real assets with inflation hedges. I think that's really important because there are a lot of paths on this probability tree given the policy uncertainty.
I would throw the same question to you, Matt. If you had the choice to choose between the U.S. corporate market and the U.S. government market, where do you go?
Well, I thought you were going to ask me versus any other else, and I'd tell you America first is clearly the policy you need to have right now, but it's America corporates versus America Treasury, so that's a little harder decision. I think that the U.S. corporate market is still set up very well. We have near-term technical challenges. We've had a little bit of a pullback from the yield-based buyer because of yields have gone lower 40, 50 basis points over the last month. But technicals are going to get a little better. Next week, you have a very heavy issuance. Probably going to see $70 billion get issued over the next week. Mars buying Kellanova, or Kellogg's with Pringles, as I like to call it. Basically, you're going to see a lot of M&A deals over the next week, but then things are going to start to slow a little bit. And I think technicals are going to get better. So as long as fundamentals hang in there and they're starting at such a very good place, we just got to get through this really tough period of technical volatility, which is caused by a lot of headlines, but it's also caused by just yields being lower. And that will be met with eventually demand once people realize that the U.S. economy is not going into recession and that this is a fairly favorable market. Even with 4+% 10-year treasuries, it's just not as great as it was just a few weeks ago.
It's like M&M cereal, really. You think about the deal activity we haven't really seen yet, right? And also the amount of discipline that has been installed in the bond market has been fascinating. We've seen a number of leveraged loan deals pulled, go to private credit instead. A lot of that is seen by the discipline being demanded by the CLO market. What do you think of that dynamic, Amanda?
I think a couple things. One, the syndicated markets are generally wide open, but there has been on the margin some discernment. I think that's healthy, right? And I think private credit has stepped in as an important kind of viable funding option for a wide range of borrowers. And I think that kind of further underscores the staying power of that asset class. On the M&A, I think it's important to parse between the strategic and the sponsor-related M&A. There's been a lot of focus so far this year on why strategic M&A hasn't rebounded more strongly. I think part of the reason is because it had been rebounding in 2024 already. Corporates were already kind of moving ahead with what they needed to do. Where we really see scope for a rebound is in sponsor-related M&A activity. Clearly, financing costs will be a larger input into the economics there, but that's really where we're watching for activity to pick up.
What would you think, Matt? Amanda had talked about the idea of taking on some credit risk. Are you going down the risk spectrum when it comes to taking on credit risk in particular?
Yeah, so in particular, we've favored U.S. high yield versus EM, so down in credit risk, but staying domestic. We would stay in the double B portion of the high yield market, though. I think if you look at the high yield market overall, it's not your father's high yield market anymore. The higher quality credits are in high yield. The lower quality credits have generally gone to private credit, possibly to bank loans. So up in quality for the most part is the entire market, but we're staying even higher quality than that because we do think they're still going to see upgrades into investment grade. The spread pickup versus IG isn't enormous. It's maybe 60 basis points to go from BBB minus to BB plus, but we think that that's warranted because we still think there's going to be more upgrades and downgrades going forward. Overall, triple B credit, I think is fine. I think you're going to see just continued retail demand is actually going to pick up now that total returns are positive. So that'll do well, and I think the crossover will do well. But we would stay away from kind of anything international at this point. I think it's just too volatile, and tariff threats are certainly domestic, but they could impact that greater.
We got to leave it there. Amanda Lynam of BlackRock and Matt Brill of Invesco, thank you both for walking us through the trade. Still ahead, the final spread, the week ahead. And it features a jobs report, Fed Chair Powell, and my favorite, Bloomberg Invest. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the week ahead. Coming up, Sunday night is Oscars night, followed by global PMIs and Fed speak from Salem on Monday. Tuesday, deal makers and investors from across the globe will join me at Bloomberg Invest in New York. More on that in a moment. Tuesday also has U.S. tariffs on Mexico, China, and Canada underway, presumably. Wednesday, ADP payrolls and the Fed's Beige Book. Thursday, an ECB rate decision, U.S. jobless claims, and earnings from Broadcom and Costco. Friday is the February U.S. jobs report and comments from Fed Chair Jay Powell. And for my final thought, let's look ahead to Bloomberg Invest, because some of the biggest names in finance, economics, and investing are gathering in New York. That includes Soros Fund Management CEO Don Fitzpatrick, Carlyle CEO Harvey Schwartz, and the CEO of A-Rod Corp, Alex Rodriguez. Before that, be sure to tune in for an exclusive interview with U.S. Treasury Secretary Scott Bessent with the host of Wall Street Week, David Weston, today at 3 p.m. Eastern. Of course, they will be speaking on the heels of Ukraine Zelensky's visit to the White House. So a lot of questions from geopolitics, a Ukraine mineral deal, the trade deadlines ahead, and everything else going on in the bond market. Of course, Scott Bessent so far has been seeing what he's wanted in the 10-year because it's lower, but maybe not for the reasons he wants. And we'll get more from him on those growth scares that are under the market. A check on those yields before we let you go. The 2-year hit that 4% level flat. And just incredible moment for the bond market coming full circle. From New York, though, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.